Vanguard is the first choice for many first-time investors because of their low fees and easy-to-use platform. However, there are a few key things that you need to be aware of before opening a stocks and shares ISA with them, some of which may even cost you money in the long term if you ignore them. First of all, it's worth knowing that on Vanguard's platform, there are different buying options for ETFs. Normally, when using an investment app like Free Trade or Trading 212, you can buy ETFs in real time, as you would any other stock. But if you want to do that on Vanguard, you need to pay extra. Here's what I mean. When buying an ETF on Vanguard's own platform, you're presented with this window that offers you two options: buying the ETF at the next available price or buying it at the live price. If you choose the first option, which is the most sensible one in my opinion, it means that you place the order now and you will go through at the next trading point, which is usually twice per day. And in the meantime, the ETF share price can go up and down. With the second option, you can skip the waiting time and avoid potential fluctuations in the share price. But if you want to do that, you need to pay an extra £7.50. While it might be tempting to buy the ETF at its live price, especially if the market is down and you spot an opportunity, in my opinion, it's not worth the money. Indeed, with the next available price option, the market might rise by 1 or 2% until your order goes through. But 1 or 2% is really not that much in the grand scheme of things. And £7.50 is a huge amount to pay for something that won't make a significant difference to your returns in the long term, especially if you're investing small amounts of money. For example, if you're investing £200 with the live price option, you're automatically £7.50 down. That is 3.75%, which is a huge fee to pay for buying a simple ETF. Obviously, as a long-term investor, the idea is to keep your investments as they are without making any changes. This means that this fee won't really matter if you decide to buy a few ETFs now and then leave them untouched for the next 30 years. However, when people start investing, they're still figuring things out. They might be buying and selling different ETFs using the live price option, thinking that it's better to make quick moves instead of waiting on the sidelines. There's nothing wrong with that. We've all been there, trying to find the best fund and switching between ETFs based on the latest YouTube videos or articles that tell you which funds are the best to invest in and why. But if I were to do that, I would avoid paying that unnecessary fee and just wait a few days until the order goes through. It's a small detail, I know, but it could save you a little bit of money when you first get started and are tempted to switch between ETFs frequently. The next thing to be aware of when buying ETFs with Vanguard is that they don't give you the option to buy fractional shares. You need to buy whole units of their ETFs. For example, this Vanguard ETF, which is very popular with investors, has a share price of approximately £93. If you wanted to invest £200 per month in this ETF, Vanguard would actually invest £186 and the remaining £16 will be left in your account as cash. Since share prices fluctuate all the time, it would be really challenging to work out the exact amount needed for those two shares every month. As a result, you will always end up with some money left in your account. This could be really frustrating, especially if you've set up a direct debit for your monthly investment and the change in the share price exceeds your fixed monthly contribution. This means you have to check your Vanguard account every month to see if your monthly contribution is enough to buy the intended number of shares. And quite often you'll find yourself with extra cash in your account because Vanguard couldn't invest it all, in which case you would have to add more money to be able to purchase additional shares. This process can be really inconvenient and requires more active monitoring of your investments than some investors may prefer. Now, it's worth noting that this is not the case with index funds. Unlike ETFs, with index funds, you have the flexibility to buy fractional shares. This adds a great deal of convenience, allowing you to invest precisely the amount you want without the constraints of fixed unit purchases. However, before you think about moving your stocks and shares ISA to a different provider, it's important to note that there aren't actually many investment platforms here in the UK that give you the option to buy fractional shares of ETFs. The only ones I know that do are Invest Engine and Trading 212, but most of the other popular ones don't allow it. So before you consider transferring your stocks and shares ISA, do some research to make sure they offer this option. Now, another thing to keep in mind about investing with Vanguard is that even if they offered fractional shares for their ETFs, they require a minimum investment of £100 per month. This can be a big challenge for new investors on a tight budget, or those who prefer to start small and gradually build up their investments. It can be especially difficult for younger investors who are just getting started and may not have the financial capacity to put in that much money every month. While £100 may not seem like a lot for many people, it can be a road roadblock for many others. So for those who want more flexibility or have budget constraints, it might be worth looking into other investment platforms with lower entry requirements. For example, you can invest in a portfolio of ETFs from just £10 per month with Invest Engine, although you do need £100 to open an account in the first place. Fidelity also offers the best deal if you want to invest a small amount into a SIP or use index funds, which heads off the fractional share dilemma. They enable you to invest £25 into a stocks and shares ISA or general investment account. Although it's worth knowing that this amount applies per fund per month. So you'll need to invest between £40 to £50 monthly in a 2-fund portfolio, which is still a good entry point. And of course, you've got free trade with a minimum trade of £2, but it's more beneficial for its general investment account though, as both the ISA and SIP accounts come with sizable annual costs attached. And trading 2 and 2 will let you stake £1 a throw with zero trading fees and no platform charges. But as before, make sure to do your own research to find the right platform for you. If you're still here, it would be greatly appreciated if you could hit the subscribe button. It really does help out small channels like mine. Thank you. Before you decide to open a stocks and shares ISA with Vanguard, there is another aspect to consider. Their selection of funds is relatively limited compared to other providers. Vanguard primarily offers bonds and equity funds, and their range is not as diverse as some other options in the market. Many famous investors often advise diversifying your investment portfolio across various asset classes, which may include commodities like gold or real estate. However, Vanguard falls short in this aspect, as they do not offer any commodities ETFs or REITs ETFs, for example. REITs are real estate investment trusts, and by investing in them, you're basically investing in the real estate market without actually owning any physical property. Including real estate investment trust in your portfolio is a smart move for diversification. But unfortunately, Vanguard doesn't offer REIT ETFs as part of their available options. Apparently, this is because they haven't received a massive demand from the UK market for REITs, because many investors already own their home as their primary asset. While that's a valid reason, it would be good to have the option for those investors who don't yet own property. I know that if you invest in the FTSE 100, you're already including a lot of REITs in your portfolio, but having the option to individually select and tailor your exposure to this asset class could be advantageous, as it would allow for a more personalized approach to building a diversified portfolio. Therefore, this limitation is something to consider if you're seeking a more comprehensive range of investment options. If you have specific preferences for including other asset classes in your investment strategy, you may want to explore other providers that offer a broader selection of products. This takes me to the last point on my list, which is that you don't necessarily need to open a stocks and shares ISA with Vanguard to be able to buy their own funds. You can have an account with a different provider and be able to invest in Vanguard funds plus many others. In fact, it's actually cheaper to buy Vanguard funds on other platforms than through their own website. This might come as a surprise, considering that Vanguard is renowned for its cost-effective options. But the truth is that they do have a relatively high platform fee of 0.15% per year, whereas other platforms such as Invest Engine, for example, charge zero fees to open an account with them. You just pay the ETF's annual charge and that's it. At the same time, other firms like Interactive Investor or Free Trade don't charge a percentage fee. Instead, you pay a fixed monthly fee which stays the same regardless of how much money you invest. This 0.15% platform fee works out in your favor when you have a small amount of money invested, but it does get bigger as your portfolio value increases. And although it's capped at £375, meaning that you won't be charged any more than that when you have more than £250,000 invested, you can avoid this yearly fee altogether if you use other platforms. Now, the main disadvantage of using a different platform is that you won't have access to Vanguard's flagship life strategy funds. But if you're not interested in them, then it doesn't matter. One last thing I want to mention is that unlike Vanguard US, they don't have an app in the UK. You're restricted to using their website. They say they haven't created one to keep fees low and to stop you from checking your investments often, as this goes against their buy and hold principle. This is another small detail to consider, but I don't think it should be a deal breaker. In the end, if you invest in an S&P 500 ETF, for example, there is no need to check your investment frequently, and it's not a huge inconvenience if you do it through their website that one time per year. Although you may be forced to check it monthly and top up your account due to the issue of not being able to buy fractional shares that we talked about earlier. But anyway, since I brought up the S&P 500, check out this video next to find out if it's the only fund that you need in your portfolio or whether you should invest in other markets as well.